Hello and welcome to Financial Intelligence. In this video, I'm going to talk about the similarities and differences between mutual funds and exchange-traded funds, or ETFs for short. If you have a 401k or IRA account, you might have heard about these terms. Mutual funds and ETFs have a lot in common. However, there are key differences between them that you should be aware of as a savvy investor. If you like the type of content that I provide on this channel, please subscribe to the channel and don't forget to like this video, and if you have any comments, add them in the comment section below, and also hit the notification bell so that you don't miss any of my future videos. A disclaimer before we get started: note that I'm not a financial advisor. The content I am sharing here is based on my research and is for educational purposes only. For professional advice, you should talk to your financial advisor. Part 1: Similarities between mutual funds and ETFs. Mutual funds and ETFs have a lot in common. Both types of funds consist of a mix of many different assets and represent a common way for investors to get market exposure. ETFs and mutual funds both pool investor money into a collection of securities, allowing investors to diversify without having to purchase and manage individual assets. For instance, if you are planning to retire in 2040, instead of hiring a personal money manager to invest your money for you, you can contribute to a fund managed by an investment firm like Vanguard. Vanguard will collect money from a large number of investors like you who are also planning to retire in 2040. Then Vanguard will hire a professional money manager who can oversee the fund and will take care of the operational aspects of it. Pooling your money together with other investors reduces the management fee each of you has to pay. Both mutual funds and ETFs are popular choices for retirement accounts such as 401k and IRA accounts. Once you purchase mutual funds or ETFs, your involvement as an investor is going to be minimal. The investment firm which has created the mutual fund or ETF is going to manage the fund for you. Part 2: Differences between mutual funds and ETFs. There are key differences in the way mutual funds and ETFs are managed. Here I'm going to talk about 5 such differences. Number 1: Active versus passive management. Generally speaking, mutual funds are actively managed, whereas ETFs are passively managed. What this means is that most mutual funds deploy active management, in which the fund's manager picks and chooses what stocks to buy and sell and when to do so. The goal of fund managers is to outperform the markets by timing their buy and sell decisions based on their research. In contrast, most ETFs choose passive investing, which means that they do not attempt to beat the markets, but rather mimic an index that has already been selected, such as the S&P 500. The rationale is that it is very difficult to beat the markets, especially when you take into account the additional fees and taxes associated with actively managing a fund. Number 2: Management fees. Active management has another downside. It tends to cost more than passively managing a fund. This is because active management requires hiring a team of professionals to conduct research as to when to buy and sell stocks in the fund. In contrast, passive management can be automated because there is no research involved and the fund's goal is to track an index. The administrative overhead associated with active management is usually reflected in the higher management fees of mutual funds. According to Morningstar, a reputable independent investment research firm, in 2018, the average annual management fee of actively managed funds was 0.67% compared to an average of 0.15 for passively managed funds, like most ETFs. Number 3, tax efficiency. ETFs are often preferred by investors for their tax efficiency compared to traditional mutual funds. There are two reasons for this. The first reason is that ETFs, especially large cap index funds or total market index funds, do not require frequent trading. Low turnover means fewer opportunities to realize gains when securities are sold from the portfolio. The second reason is that ETFs do not need to directly sell positions from their portfolio to meet redemptions, which protects investors from taxable capital gains distributions. This is not the case with mutual funds. If the outflow of money is larger than the inflow, fund managers have to sell some positions to meet redemptions, which results in taxable capital gains. Investors should be aware that tax efficient does not mean tax-free. The primary benefit of ETFs from a tax perspective is that they can allow investors to defer the realization of capital gains taxes. Investors in ETFs will still pay taxes on regular distributions of income, and they will also pay capital gain taxes when they sell an ETF. An important thing to note here is that the tax efficiency of ETFs is less pronounced if you hold your mutual funds in tax-advantaged accounts. Number 4, liquidity. Purchases and sales of mutual funds take place directly between investors and the fund. For example, Vanguard. The price of the fund is not determined until the end of the business day when net asset value of the fund is determined. In contrast, ETFs can be traded throughout the day like stocks, with their prices determined based on supply and demand. The stock-like trading structure of ETFs also means that when you buy or sell, you might have to pay a commission and also lose the bid-ask spread. Whereas mutual funds offer a single price to both buyers and sellers, ETFs demand a higher price for buyers than they provide to sellers. This means that there's a bid-ask spread that you will be charged every time you trade ETFs. Number 5, the minimum investment requirement. Mutual funds can have high costs of entry. Even target date mutual funds, which help investors save for specific goals, often have minimums of $1,000 or more. However, ETFs can be purchased by the share, lowering the cost of establishing a position or adding to an existing one. Main takeaways. Mutual funds and exchange traded funds, or ETFs for short, have a lot in common. However, there are also key differences between them that can have a significant impact on their performance. The main difference is that most mutual funds are actively managed, whereas ETFs are generally managed passively. This means that investment decisions for mutual funds are made by professional money managers in an effort to beat the average market returns. This adds to the overall management cost associated with mutual funds. Since ETFs are passively managed, they have lower turnover, meaning that stocks are not bought as frequently as it is the case with mutual funds. Therefore, ETFs benefit from lower exposure to capital gain taxes. I hope that you like this video. If you have any recommendations or suggestions, please add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.